Welcome back to the Dividend Diplomats YouTube channel, everyone. Lanny, Bert, you know us by now. The Dividend Diplomats are here to talk to you about two undervalued dividend growth stocks in about as opposite of sectors as you are going to have in one video.
Definitely two opposite sectors, guys, but there's two things you guys need to do is you guys need to subscribe to this channel. Definitely hit that like button for the dividend investing community out there so we can keep cranking out that dividend investing content, guys, putting out dividend stock analyses left and right, up market, down market, gold jacket, green jacket, who gives a you know what.
Couldn't have said it better myself, Lanny. So what are we going to do today? We're going to keep looking at these stocks. We're going to run them through our screener. We're going to see how they hold up against each other. We're going to see how they hold up against the sector, against the S&P 500. And then we're going to say, are we buying these suckers? Are we watching them? Or are we just passing on them all together? We're slap happy here, everybody, today. So this might be a long one for all of you viewers. So what are we going to do? Lanny, first, before we talk about these two companies, what the heck is going on in the market the last week or so? It's wild.
The S&P 500 keeps ripping up day after day after day after day. I mean, guys, last month the S&P 500 is up 13%. Obviously, the filming of this video is August 16th. Now, on top of that, guys, Wall Street bets, the meme stocks are in full effect. You know, you've got GameStop, AMC, Bed Bath & Beyond, all extremely volatile stocks that are popping up like crazy. So
yeah, hey, Wall Street bets, Paramount, take a look at it. Just throwing it out there for you in case you're watching this.
Just mention it for a friend.
Yeah.
But yeah, extremely crazy right now. You know, the other big question is, you know, a lot of people in the investing community have been asking in the comments, you know, Bert, are you in the doghouse right now?
I'm always in the doghouse. You can ask my wife. I'm always down there. I basically live in there. Throw a nice little bed in there, you know, get some nice Wi-Fi in there so we can edit these videos while I'm sleeping in there. But yeah, no, we're in the doghouse for some of our investments. But the good news is, I mean, it's earnings season continues to surprise and it's causing some optimism in the market. So even though we're in the doghouse for some, what you're seeing is we're swinging back up again. Home Depot's crushing it. Walmart's pushing ahead. A lot of retail's coming in better than expected, pushing a lot of those undervalued stocks that we covered a month ago into less undervalued territory, or I guess you would say more fairly valued territory where they're not exactly on our radar. So finding undervalued stocks is kind of difficult again.
Difficult, but not impossible, guys, because we always put on the little magnifying glass. We get out the stock screener, obviously focus on the three metrics: price to earnings ratio less than the S&P 500, dividend payout ratio less than 60%, history of growing their dividend, and then we also look at the dividend yield. You guys probably remember the video that we showcased earlier in the week talking about eBay stock and if that's a stock to buy right now. Well, we're still going to hang out in the tech sector. No, we're not talking about IBM, not Apple, Microsoft, Tesla, Netflix, you name it. No, we're talking about another tech stock. And then, you know, what goes with tech? Food. So we're going to talk about a food company as well, Bert.
Yeah, and for the love of God, everybody, that tech company is not Intel either. So I want to get that one out of the way here. We're going to talk about a place that had the stadium name sponsorship of the location of where the Cavs won their championship, Lanny. Isn't that right? Game 7, 2016 NBA Finals. We didn't win it in Cleveland. Where did we win it, Lanny?
Bring it to Oracle, baby. We're going back to Oracle. Ticker symbol ORCL. And a lot of people went out to celebrate by eating a heck of a lot of chicken. Tyson chicken. Ticker symbol TSN. The two stocks that we're about to crush through a review.
Yeah, so let's talk through Oracle first. Obviously, the tech sector continues to, it's starting to rebound now from the lows that it had several months ago. What you're seeing with Oracle, well, you still have a lot of other companies in the tech communities. You saw some layoffs, so they're cutting some costs. They're getting rid of some people, keeping salaries down to help fight some of the tightening up that you're seeing from that top line revenue and that net income. So they're fighting it there. What's interesting about Oracle when you read about the news is even though tech's going through some tough times. They're winning some big contracts. They're extending their current AT&T cloud management contract. They're expanding their partnership with Microsoft. These aren't small dollar amount contracts for Oracle. These are cash flow producing contracts with two of the largest companies, and there are hundreds of other ones just like that sitting out there. So they're getting some wins, saving some expenses, and keeping that revenue flowing in.
Yeah, I mean, it's no question that tech, in and of itself, has been very volatile this year. In fact, over the course of 2022, the NASDAQ is down over 17%. So definitely the harder hit arena versus other indices out there. A lot of layoffs consistent across the board, the overhiring, and then now the unloading. But guys, guess what? It's time to see if it's a dividend stock to buy. There's also the other stock that we mentioned with Tyson Foods. A lot of things are going on with Tyson. No, not Mike Tyson, but we're talking about the big chicken producer here.
Yeah, they're getting hit right now with some they had an interesting earnings release and the stock went flying down after. But similar to the point you brought up with the NASDAQ, even after the pullback that occurred after earnings, Tyson is only down 6.5% year to date, and they're up 1.65% over the last 52 weeks. So despite the bad news and despite some of the stuff that happened, they are still beating the market. So what really happened there was revenue was up, but net income fell down and operating income come down. They were hit by some of that cost. So what are they going to do to compensate? Prices are going up in the third quarter. They're done taking on this inflation and supply chain issues all on their own. They're finally starting to pass it along to the consumer. They're building out their own cost saving plans too, just like some of the other major players, to help offset some of the increased costs that they're doing. So they're cutting some other things to find out. So they're fighting. I think it's interesting what's going on there. But at the end of the day with Tyson, I think the funniest part in all of this is, despite the negative news, their full year guidance is still staying the same. It's still going to be 52 billion to 54 billion. A lot of money.
Wow. A lot of revenue right there, guys. And it's no question at the grocery store at the checkout, definitely have seen anywhere between 10% to 15% price increases on chicken breast, ground chicken, you name it. Anything chicken related has gone up.
Yep. And what you're seeing in the financials too, one of their pieces is prices are going up, revenue's going up, but volumes are decreasing. So what you just highlighted there, Lanny, not surprising at all, considering as people are dealing with these increased food costs, you have to make sacrifices somewhere.
Yeah. I mean, there's no question there, guys. We're all feeling it. We're all seeing it. It's real. Even though inflation, gas may be going down, food continues to go up, guys. So obviously Tyson probably, they'll still be okay because, consumers are still going to pay for their chicken. But yeah, as Bert said, maybe buy just a little bit less of it, or buy a little bit less of other things to help offset that cost increase on poultry. But so now, Bert, go ahead.
I was going to say, let's run them through the screener. Let's see that. We're going to go through, we'll do Oracle first, and then we'll do Oracle first, followed by Tyson. Let's see how they go.
Followed by Tyson, followed by Charmander Shadowless. Let's go.
All right, let's keep going here. Told you guys we're a little slap happy tonight. Oracle, first metric, PE ratio, price 79.52, forward earnings $5.25, PE ratio 15.15.
15.15, less than the S&P 500, which is about 20 times earnings right now. Fairly undervalued for a tech stock that's usually higher on the PE ratio. Now, Bert, let's look at that dividend payout ratio, that second metric for good old Oracle. I'm stepping into the arena. I'm from Cleveland. We're about to take this down. Actually, Bert, you're from Cleveland. I'm from Akron. So they pay a dividend of $1.28 per share per year spread over 4 quarters. So $1.28 over that $5.25, guys. This is an alarmingly low dividend payout ratio, which we love in the tech industry. Fairly consistent there at only 24%. And Bert, why do you love a low payout ratio here with Oracle?
It's a capital intensive business. So yeah, you need to keep a big chunk of your earnings to pour back into the business. So let's see that third metric, the dividend growth. Their 5-year dividend growth rate, 13.49%. They've increased that dividend for 8 consecutive years. Yeah, great stuff, building out that streak almost at double digits. Interestingly, they crushed their last dividend increase in June of 2022. They announced an 18.5% dividend increase. So they crushed their 5-year average back in June. Yeah,
Yeah,
brush off that shoulder.
my wife owns Oracle, so when she got that dividend stock, I was like, we did it." She's like, "Oh my God, what do we do?" And I'm like, "You got the dividend increase." She's like, "Great."
She's like, back to the doghouse. Get down there. Go back to the doghouse. Okay, all right. So that bonus metric, the dividend yield, they're currently yielding 1.61%. So just a skosh above the S&P 500. That being said, if you're not going to crush the S&P 500, you're going to be a lower yielding stock like that. You want to see a strong average dividend growth rate there. Low yield, high growth rate. That's the exact combination we like to see, and that's what Oracle delivers.
Yeah, guys, again, down almost 10% this year, down almost 13%, 52 weeks. Not a bad tech stock that is definitely in the forward-looking arena of technology. Oracle, ticker symbol ORCL. Bert, it's time to dive in to Tyson. It's time to see how great is this chicken. Is this a great stock to buy right now for your dividend stock portfolio?
Yeah, our current share price 82.09, forward EPS 764. PE ratio is 10.74. So you could probably get about 2 pounds of chicken for that PE ratio.
Yeah, you should be able to get a couple more, maybe 3 pounds. Maybe if you're lucky. By the big pack, by the big one, right?
That's true. Yeah, you might need to go value. You might need to buy 15 pounds to get that price. No, I'm kidding. Yeah, nice 5-pound pack of chicken there to get a
pretty low PE ratio, though.
Yeah, very low PE. So let's check out the payout ratio, see what's going on there. Annual dividend $1.84. Divide that by 40 EPS of 764. Another stock with a low payout ratio of 24.08%.
Now, as dividend investors, we need to see dividend growth. We need that passive income stream to continue to grow without doing anything. With the payout ratio at 24%, you better believe Tyson juices up that dividend. They make that fully flavored high dividend growth right here at 17.82% 5-year average. Again, 8 years as well going forward.
It's better for them to juice up that dividend than juice up the chickens that they're selling you. So that's a good thing. Although, interestingly, unlike Oracle, Tyson had a pretty pathetic dividend increase in November 2021. There's nothing more to really say than that. It was only 3.4%. So I don't know. I don't think you need to be a mathematician to tell you that does not beat their 5-year average.
Now, though it doesn't beat it, we'll have to see what they do this coming Q4. Very excited to see what Tyson does, given that they're battling, obviously, the higher cost and really seeing what they do and how they perform in this second half of the year. But hey, they're yielding now finally as a bonus metric over 2% at 2.24% dividend yield, 63 basis points higher than Oracle.
Yeah. So, I mean, yield climbing, obviously, when the price falls, yield climbs. So it's an interesting mix. So overall, to summarize, Oracle, PE ratio 1550, payout 24%, 5-year dividend growth rate 13%, 8 years of increase in that dividend, and a yield of 1.61%.
All right, Bert, you own shares of Tyson, I know. In our house, we have shares of Oracle. What you gonna do, brother, when these two dividend stocks are running wild right now?
I think it's gonna fall for me exactly what I would expect it to be, which would be they're gonna stay on my watch list for now. I'm not running to buy either at the moment, but the metrics are looking pretty solid, and I think they've earned a spot on the watch list. And if there is a sudden drop in any one of the prices, I could definitely see myself adding to Tyson if that yield climbs above 2.5%. Oracle, if that yield ever hits 2%, I could easily see myself adding some.
So you're saying there's a chance?
Yeah, there's always a chance. So be it if it's ever, and let us know what you think of Oracle, what you think of Tyson. Are you buying, watching, avoiding, or if you have a stake, are you selling it? And let us know in that comment section down here. Just look down.
God,
that's where the comments are.
What other dividend stocks are you buying in this rising stock market? We all know that ever since the S&P 500 entered that bear market, We have now recovered about, what was it, 50% of the unrealized or the, kind of losses year to date in the stock market. Are you still buying regardless of the noise, regardless of what the stock market is doing? Let us know what you've been scooping up out there in the investing community.
And if you're in the market for a shadowless base set Charmander, you know who to hit up right here. So let us know that in the comment section as well. And if you haven't already, subscribe, give us that thumbs up. Thanks, everybody. These were 2 undervalued dividend stocks. Hopefully there are plenty of other ones out there. Regardless, just keep buying those stocks and growing your passive income.
Guys, that was Bert the Hurt and Lanny from the Dividend Diplomats. Over and out.